Hello everybody, this is How to Econ. Let's talk about money. We will see what money is, how the Fed measures money, what the roles of banks are, and how banks create money. Money is important to us all because without money, economies have to engage in the barter system. Barter, which is trading one good or service for another, is highly inefficient for trying to coordinate the trades in a modern economy, and the barter system does not allow easy participation into future contracts for purchasing many goods and services. In an economy without money, an exchange between two people would involve a double coincidence at once, a situation in which two people each wants some good or service that the other person can provide. Money solves the problems that the barter system creates. So what is money? Money is whatever serves a society in the four following functions. 1. Medium of exchange. 2. Store of value. 3. Unit of account. And 4. Standard of deferred payment. First, money serves as the medium of exchange, which means that money acts as an intermediary between the buyer and the seller. For example, I am a professor and I sell my economic knowledge for money, which is my salary. Then I use this money to buy some donuts. Without money, how would I get those donuts? I would have to find a bakery that wants to take some econ lessons from me, negotiate how many donuts could be bought with one econ lesson, then we exchange econ lessons for donuts. This whole process is not easy to do, and I might never get to eat donuts since I cannot make it myself. Life is sad without donuts. Keep in mind that to serve as a medium of exchange, people must widely accept money as a method of payment in the markets for goods, labor, and financial capital. Second, money must serve as a store of value. In a barter system, we saw the example of the tomato farmer trading tomatoes for a dress. However, she risks having her tomatoes go bad, especially if she keeps them in a warehouse for too long. Their value will decrease with each day. Tomatoes are not a good store of value. Holding money is a much easier way of storing value. You know that you do not need to spend it immediately because it will still hold its value approximately the next day or the next year. This function of money does not require that money is a perfect store of value. In an economy with inflation, money loses some buying power each year, but it remains money. Third, money serves as a unit of account, which means that it is the ruler by which we measure values. For example, an accountant may charge $100 to file your tax return. That $100 can purchase 2 pairs of shoes at $50 a pair. Money acts as a common denominator, an accounting method that simplifies thinking about trade-offs. Finally, another function of money is that it must serve as a standard of deferred payment. This means that if money is usable today to make purchases, it must also be acceptable to make purchases today that the buyer will pay in the future. Loans and future agreements are stated in monetary terms, and the standard of deferred payment is what allows us to buy goods and services today and pay in the future. Thus, money serves all of these functions. It is a medium of exchange, store of value, unit of account, and standard of deferred payment. Money has taken a wide variety of forms in different cultures. People have used gold, silver, cowrie shells, cigarettes, and even cocoa beans as money. Although we use these items as commodity money, they also have a value from use as something other than money. For example, people have used gold throughout the ages as money, although today we do not use it as money, but rather value it for its other attributes. Gold is a good conductor of electricity, and the electronics and aerospace industry use it. Other industries use gold too, such as to manufacture energy-efficient reflective glass for skyscrapers, and is used in the medical industry as well. Of course, gold also has value because of its beauty and malleability in creating jewelry. As commodity money, gold has historically served its purpose as a medium of exchange, a store of value, and as a unit of account. Commodity-backed currencies are dollar bills or other currencies with values backed up by gold or other commodities held at a bank. During much of its history, gold and silver backed the money supply in the United States. As economies grew and became more global in nature, the use of commodity monies became more cumbersome. Countries moved towards the use of fiat money. Fiat money has no intrinsic value but is declared by a government to be a country's legal tender. The only backing of our money is universal faith and trust that the currency has value and nothing more. The Federal Reserve Bank, which is the central bank of the United States and a bank regulator, defines money according to its liquidity. There are two definitions of money, M1 and M2 money supply. Begin in May 2020. M1 money supply includes those monies that are very liquid, such as cash, checkable deposits, traveler's checks, and savings. M2 money supply includes those monies that are less liquid in nature. So M2 include M1 plus time deposits, certificates of deposits, and money market funds. Many banks and other financial institutions offer a chance to invest in money market funds, where they pool together the deposits of many individual investors and invest them in a safe way, such as short-term government bonds. Certificates of deposit, or we call it CDs, or time deposits, are accounts that the depositor has committed to living in the bank for a certain period of time, ranging from a few months to a few years, in exchange for a higher interest rate. The Federal Reserve System is responsible for tracking the amounts of M1 and M2 and prepares a weekly release of information about the money supply. Where does plastic money like debit cards, credit cards, and smart money fit into this picture? A debit card, like a check, is an instruction to the user's bank to transfer money directly and immediately from your bank account to the seller. It is important to note that in our definition of money, it is checkable deposits that are money, not the paper check or the debit card. Although you can make a purchase with a credit card, the financial institution does not consider it money either, but rather a short-term loan from the credit card company to you. When you make a credit card purchase, the credit card company immediately transfers money from its checking account to the seller, and at the end of the month, the credit card company sends you a bill for what you have charged that month. Until you pay the credit card bill, you have effectively borrowed money from the credit card company. With a smart card, you can store a certain value of money on the card and then use the card to make purchases. In short, credit cards, debit cards, and smart cards are different ways to move money when you make a purchase. However, having more credit cards or debit cards does not change the quantity of money in the economy any more than printing more checks increases the amount of money in your checking account. One key message underlying this discussion of M1 and M2 is that money in a modern economy is not just paper bills and coins. Instead, money is closely linked to bank accounts. The banking system largely conducts macroeconomic policies concerning money. In the next few minutes, I will explain how banks function and how a nation's banking system has the power to create money. Most money is in the form of bank accounts, which exist only as electronic records on computers at banks. Banks make it easier for a complex economy to carry out the extraordinary range of transactions that occur in goods, labor, and financial capital markets. A bank allows people and businesses to store their money in either a checking account or savings account, and then withdraw this money as needed through the use of a direct withdrawal, writing a check, or using a debit card. Banks are a critical intermediary in what we call the payment system, which helps an economy exchange goods and services for money or other financial assets. So, those with extra money that they would like to save can store their money in a bank rather than look for an individual who is willing to borrow it from them and then repay them at a later date. Those who want to borrow money can go directly to a bank rather than trying to find someone to lend them cash. Transaction costs are the costs associated with finding a lender or a borrower for this money. Thus, banks lower transaction costs and act as financial intermediaries. They bring savers and borrowers together. Along with making transactions much safer and easier, banks also play a key role in creating money. Banks are a financial intermediary, that is, an institution that operates between a saver who deposits money in a bank and a borrower who receives a loan from that bank. Financial intermediaries include other institutions in the financial market, such as insurance companies and pension funds, but we will not include them in this discussion because they are not depository institutions, which are institutions that accept money deposits and then use this to make loans. All the deposited funds mingle in one big pool, which the financial institution then lends. This figure on the screen illustrates the position of banks as financial intermediaries with deposits flowing into a bank and loans flowing out. A bank uses balance sheets to keep track of its money flows. A balance sheet is an accounting tool that lists assets and liabilities. An asset is something of value that a bank owns and it can use to produce something. A liability is a debt or something a bank owes. The net worth is the asset value minus how much is owed or the liability. A bank's net worth is called bank capital. The table on the screen illustrates a hypothetical and simplified balance sheet for the safe and secure bank. Because of the two-column format of the balance sheet with the T-shape formed by the vertical line down the middle and the horizontal line under assets and liabilities, we sometimes call it a T account. The T in a T account separates the assets of a firm on the left from its liabilities on the right. All firms use T accounts, though most are much more complex. For a bank, the assets are the financial instruments that either the bank is holding, its reverse, or those instruments where other parties owe money to the bank, like loans made by the bank and the U.S. government securities, such as U.S. Treasury bonds purchased by the bank. Liabilities are what the bank owes to others. Specifically, the bank owes any deposits made in the bank to those who have made them. The net worth of the bank is the total assets minus total liabilities. Net worth is included on the liability side to have the T account balanced to zero. For a healthy business, net worth will be positive. For a bankrupt firm, net worth will be negative. In either case, on a bank's T account, assets will always equal liabilities plus net worth. When bank customers deposit money into a checking account, savings account, or a certificate of deposit, the bank views these deposits as liabilities. After all, the bank owes these deposits to its customers when the customers wish to withdraw their money. In the example on the screen, this bank holds $10 million in deposits. Loans are the first category of bank assets in this T-table example. Say that a family takes out a 30-year mortgage loan to purchase a house, which means that the borrower will repay the loan over the next 30 years. This loan is clearly an asset from the bank's perspective because the borrower has the legal obligation to make payments to the bank over time. However, in practical terms, how can we measure the value of the mortgage loan that the borrower is paying over 30 years in the present? One way of measuring the value of something, whether a loan or anything else, is by estimating what another party in the market is willing to pay for it. Many banks issue home loans and charge various handling and processing fees for doing so, but then sell the loans to other banks or financial institutions who collect the loan payments. We call the market where financial institutions make loans to borrowers the primary loan market, while the market in which financial institutions buy and sell these loans is the secondary loan market. For the safe and secure bank in this example, the total value of its loans, if they sold them to other financial institutions in the secondary market, is $5 million. The second category of bank asset is bonds, which are a common mechanism for borrowing, used by the federal and local government, and also private companies and non-profit organizations. A bank takes some of the money it has received in deposits and uses the money to buy bonds. Government bonds are low risk because the government is virtually certain to pay off the bond. However, it has a lower rate of interest. These bonds are an asset for banks in the same way that loans are an asset. The bank will receive a stream of payments in the future. In our example, the Safe and Secure Bank holds bonds worth a total value of $4 million. The final entry under assets is reserves, which is money that the bank keeps on hand and that it does not lend or invest in bonds, and thus does not lead to interest payments. The Federal Reserve requires that banks keep a certain percentage of depositors' money on reserve, which means either in their vaults or at the Federal Reserve Bank. We call this a reserve requirement. Additionally, banks may also want to keep a certain amount of reserves on hand in excess of what is required. The Safe and Secure Bank in this example is holding $2 million in reserves. We define net worth of a bank as its total assets minus its total liabilities. For this bank in this example, the net worth is equal to $1 million. That is $11 million in assets minus $10 million in liabilities. A bank that is bankrupt will have a negative net worth, meaning its assets will be worth less than its liabilities. How can this happen? Again, look at the balance sheet helps to explain. A well-run bank will assume that a small percentage of borrowers will not repay their loans on time or at all and factor these missing payments into its planning. Remember, the calculations of the bank's expenses every year include a factor for loans that borrowers do not repay, and the value of a bank's loans on its balance sheet assumes a certain level of riskiness because some customers will not repay loans. Even if a bank expects a certain number of loan defaults, it will suffer if the number of loan defaults is much greater than expected, as can happen during a recession. The risk of an unexpectedly high level of loan defaults can be especially difficult for banks because a bank's liabilities, namely its customers' deposits. Customers can withdraw funds quickly, but many of the bank's assets like loans and bonds will only be repaid over years or even decades. This asset-liability time mismatch, which means the ability for customers to withdraw bank's liabilities in the short term while customers repay its assets in the long term, can cause severe problems for a bank. For example, imagine a bank that has loaned a substantial amount of money at a certain interest rate, but then sees interest rates rise substantially. The bank can find itself in a precarious situation. If it does not raise the interest rate it pays to depositors, then deposits will flow to other institutions that offer the higher interest rates that are now prevailing. However, if the bank raises the interest rates that it pays to depositors, it may end up in a situation where it is paying a higher interest rate to depositors than it is collecting from those past loans that have lower interest rates. Clearly, the bank cannot survive in the long term if it is paying out more interest to depositors than it is receiving from borrowers. How can banks protect themselves against an unexpectedly high rate of loan defaults and against the risk of an asset-liability time mismatch? One strategy is for a bank to diversify its loans, which means lending to a variety of customers. Along with that, banks have several other strategies to reduce the risk of an unexpectedly large number of loan defaults. For example, banks can sell some of the loans they make in the secondary loan market, as we described earlier, and holding a greater share of assets in the form of government bonds or reserves. Nevertheless, in a lengthy recession, most banks will see their net worth decline because customers will not repay a higher share of loans in tough economic times. Banks and money are intertwined. It is not just that most money is in the form of bank accounts. The banking system can literally create money through the process of making loans. Let's see how. Start with a hypothetical bank called Singleton Bank. The bank has $10 million in deposits. The first table shows the T-account balance sheet for Singleton Bank when it holds all of the deposits in its vaults. At this stage, Singleton Bank is simply storing money for depositors and does not have income to pay its depositors an interest rate yet. The Federal Reserve requires Singleton Bank to keep $1 million on reserve, which is 10% of total deposits. It will loan out the remaining $9 million. By loaning out the $9 million and charging interest, it will be able to make interest payments to depositors and earn interest income for Singleton Bank. For now, we will keep it simple and not put interest income on the balance sheet. Instead of becoming just a storage place for deposits, Singleton Bank can become a financial intermediary between savers and borrowers. This change in business plan alters Singleton Bank's balance sheet, as the second table shows. Singleton's assets have changed. It now has $1 million in reserves and a loan to Hank's Auto Supply of $9 million. The bank still has $10 million in deposits. Singleton Bank lends $9 million to Hank's Auto Supply. The bank records this loan by making an entry on the balance sheet to indicate that it has made a loan. This loan is an asset because it will generate interest income for the bank. Of course, the loan officer will not let Hank walk out of the bank with $9 million in cash. The bank issues Hank's Auto Supply a cashier's check for the $9 million. Hank deposits the loan in his regular checking account with First National Bank. The deposits at First National Bank rise by $9 million and its reserves also rise by $9 million, as the third table shows. The First National Bank must hold 10% of additional deposits as required reserves, but is free to loan out the rest. Making loans that are deposited into a demand deposit account increases the M1 money supplied. Remember, the definition of M1 includes checkable deposits, which one can easily use as a medium of exchange to buy goods and services. Notice that the money supply is now $19 million, $10 million in deposits in Singleton Bank, and $9 million in deposits at First National Bank. So far, bank lending has expanded the money supply by $9 million. Now, First National Bank must hold only 10% as required reserve, which is $900,000, but can lend out the other 90%, which is $8.1 million, in a loan to Jack's Chevy dealership as in Table 4. If Jack's deposits the loan in its checking account at Second National Bank, the money supply just increased by an additional $8.1 million, as Table 5 shows. How is this money creation possible? It is possible because there are multiple banks in the financial system. They are required to hold only a fraction of their deposits, and loans end up deposited in other banks, which increases deposits and, in essence, the money supply. In a system with multiple banks, if all banks loan out their excess reserves, the money supply will expand. We determine the amount of money that the system can create by using the money multiplier. This tells us by how many times a loan will be multiplied as it is spent in the economy and then redeposited in other banks. The money multiplier formula is 1 over reserve requirement. We then multiply the money multiplier by the change in excess reserves to determine the total amount of M1 money supply created in the banking system. Let's do a quick example. If the reserve requirement is 10% and a bank's excess reserves are $9 million, what is the change in the M1 money supply? First of all, the money multiplier is 1 divided by the reserve requirement 10% or 0.1, which is equal to 10. The excess reserves are $9 million, so the total change in M1 money supply is 10 times $9 million. Thus, we can say that in this example, the total quantity of money generated in this economy after all rounds of lending are completed will be $90 million. The money multiplier will depend on the proportion of reserves that the Federal Reserve Bank requires banks to hold. Additionally, a bank can also choose to hold extra reserves. Banks may decide to vary how much they hold in reserves for two reasons: macroeconomic conditions and government rules. When an economy is in recession, banks are likely to hold a higher proportion of reserves because they fear that customers are less likely to repay loans when the economy is slow. The Federal Reserve may also raise or lower the required reserves held by banks as a policy move to affect the quantity of money in an economy. The process of how banks create money shows how the quantity of money in an economy is closely linked to the quantity of lending or credit in the economy. All the money in the economy except for the original reserves is a result of bank loans that institutions repeatedly redeposit and loan. Finally, the money multiplier depends on people redepositing the money that they receive in the banking system. If people instead store their cash in safe deposit boxes or in shoe boxes hidden in their closet, then banks cannot recirculate the money in the form of loans. Central banks have an incentive to assure that bank deposits are safe because if people worry that they may lose their bank deposits, they may start holding more money in cash instead of depositing it in banks, and the quantity of loans in an economy will decline. That is it for now. I will leave you with another quick example here. Keep calm and study on.